The four most dangerous words in investing are, this time is different. In 2025, the world believed them. We were told that the institutional supercycle had arrived, and the wild 80% drawdown of the past was a relic of a primitive and retail-driven era. But as we stand here in 2026, the illusion has shattered. Bitcoin isn't maturing, it's being liquidated. The bag holders this time isn't just retail, it's sovereign states and Fortune 500 companies. Every bubble needs a new era narrative. In the 2024 and 25 run, the narrative was built on three pillars. First, the ETF shield. With companies like BlackRock entering the game, a math equation appeared. The math was simple. A 1% allocation of the global pension funds would create a permanent floor. Second, sovereign legitimacy. El Salvador's accumulation and Bhutan's massive mining operation would turn Bitcoin into a reserve asset. And third, the sailor effect. Company treasuries, led by MicroStrategy, were locking up the supply. We were told a supply crunch was inevitable. By October 25, Bitcoin hit all-time high and the supercycle felt alive. But February 26 brought a cold reality check. We learned that institutional investors aren't diamond hand believers, they are risk-averse allocators. The data reveals a critical flaw. The average cost basis for the 2025 ETF cohort was approximately 84,000. When the price drifted towards 72,000, the smart money started to panic. In late January 26 alone, we saw a $2.8 billion ETF outflow. This is the ETF Reflexivity Trap. In a rising market, ETF drives price higher. But in a falling market, the mechanisms works in reverse. When an investor sells a ETF, the issuer needs to sell the underlying Bitcoin in the spot market. The shield has become a sword, accelerating the fall. The peak at 126k wasn't just math, it was politics. The market priced in a crypto utopia after the 24 election. Investors expected immediate deregulation and Bitcoin reserves. But by early 26, the so-called Trump premium met the reality of governance. Legislative gridlock and government shutdown led crypto to the back burner. It was a classic buy the rumor, sell the news, but on a global trillion-dollar scale. Just like the 2017 CME future launch and the IPO of Coinbase in 2021. The very event that meant to trigger the market to the absolute top. The carnage is most visible in corporate boardrooms. MicroStrategy has become a volatility machine. With over 700,000 Bitcoin at a cost basis of approximately 76,000, they are now underwater. If Bitcoin hit 30,000, they are looking at a staggering loss of $32 billion. Michael Burry warned of this death spiral. If the stock premium collapses, the infinite money glitch of selling equity to buy Bitcoin breaks. Even nations are reeling. El Salvador's reserves are shrinking, giving the IMF massive leverage to demand repeal of the Bitcoin law. And in Bhutan, the halving in 24 has made crypto mining so expensive that it's more profitable to sell their electricity to India than continue mining. The digital hydro has become a fictional drain. The contagion has reached Europe. The Norwegian oil fund doesn't own Bitcoin directly, but their stakes in MicroStrategy and Tesla means Norwegian pensioners are essentially losing hundreds of millions. In total, we are witnessing a $2.4 trillion wipeout in global wealth. This is a negative wealth effect. When millions of investors are losing their savings, they are going to stop spending. This isn't just magic money disappearing. It's a deflationary shock to the wider economy. The descent to 25k isn't an anomaly. It's a structural necessity. Every cycle needs a purge of leverage and a return to the mean. The "this time is different" narrative was an illusion yet again. The winners, the cash-rich value investors and the short sellers. The losers, those who have believed history had stopped rhyming. As we head towards the cycle floor, the lesson remains. Liquidity is discriminated and gravity is a law, not a suggestion. Is this the end of Bitcoin or just another winter? See you next time.